Welcome back, you legends. I'm Dr. Cal. Let's get right into this video. The stock market today was down slightly on the S&P, 0.67%, down 0.85% on the Nasdaq, and down 0.33% on the Dow, largely lifted by the strength in the energy sector. Let's take a look at the different sectors, everybody. Leading today was energy, and lagging was real estate, cyclicals, healthcare, and financials. Now, real estate took a really big hit when the housing data came out. Look at this, everybody. 30-year mortgage rates, record high, 6.94%. Housing starts significantly weaker. Housing starts significantly weaker than expected, but surprisingly, everybody, building permits, which predict future building, are actually up 1.56 million, significantly higher than forecasted. And this figure, everybody, does not bode well for inflation. And as a result, we saw the 10-year yield shoot to the upside and the 2-year yield shoot to the upside as well, both of which influence the Nasdaq and the S&P 500 directly. And so we saw weakness in the S&P and weakness in the Nasdaq today. It also provided some uplift to energy, because if future housing demand is going up, it indicates that the economy is accelerating, and it means that inflation may be accelerating. And so energy speculators were all over this, buying energy stocks. Now let's take a look at the stock market map, everybody. It's mostly red, but we do have some pockets of green, including semiconductor equipment, because ASML beat on its earnings report, which is what I was expecting. They beat, and they said that the US-China export restrictions would not affect any of their shipments meaningfully. That's largely because ASML operates out of the Netherlands, but Lam Research, another equipment provider, told a completely different story. They said that their revenue would be impacted by over $2 billion next year, just because of these new export restrictions into China. And so if you're looking to trade the chips stocks, if you're looking to trade semiconductors, which has been the best performing sector in the S&P 500 for the last 6 or 7 years, you will have to be very picky and really know what you're doing, especially as these restrictions heighten the risk to the downside in this sector. Now we also had Netflix up 13% because of that massive beat on earnings that we talked about yesterday. The rest of the semiconductor sector doing okay as well. Tesla doing fine leading into earnings. But unfortunately, everybody, Tesla reported mixed results. They beat on profits, but they missed on revenues. Profits were up because of pricing increases in vehicles, but shipments are slightly down versus the forecast for 2022. Tesla expects to finish the year just shy of its 22 target of boosting vehicle deliveries by 50%. Still an amazing quarter for Tesla. Elon Musk very positive in a beat, saying that Tesla will be recession resilient. We are going pedal to the metal come rain or shine. Now the Tesla chart has been beaten up significantly over the last couple of weeks, and the company sold off massively in the post-market trading hours, down 6% to $208. So tomorrow will likely open with a gap down, but I actually expect Tesla to do okay. To me, the report is okay. Expectations were super high. Tesla did okay. Profits are up, deliveries slightly down, revenue slightly down. So it's a mixed report. I don't think that this would warrant a sell-off in Tesla. So I think Tesla might chop around, perhaps gap down, and begin to see some buying off the lows of the day. Now let's take a look at the daily chart for the S&P 500, everybody. We had a bit of an indecision doji candle today. We opened down, we sold off, then we rallied, sold off again, and we had this indecision doji. That market does not know what it wants to do. This is very typical, everybody, when the VIX is super high at 30 plus, and especially when we're in the midst of the earnings season. Now with that said, we're still above the 5-day moving average, which is now inclining. We're above the 9-day moving average and the 20-day moving average, which have now flattened, both of which are bullish signals. But I'd be remiss if I did not warn about this really ugly looking gap that we have right here. We do have the market forming somewhat of a pennant looking structure here, everybody. Now, a gap down tomorrow could accelerate the selling to fill this gap at $360. In the short term, I still remain bullish for November and December. In the very short term, everybody, in the next couple of weeks, I still remain very, very cautious, exceptionally cautious because of seasonality. Look at this, everybody. The last week of October tends to be one of the weakest in the entirety of the year, seasonally speaking, especially in midterm years. We had a bit of a choppy trading period the last 3 weeks, 2 to 3 weeks. We are now entering this period of heightened risk. I was hoping to see the S&P 500 actually rally to 380 before seeing some weakness. We came short of that. We're just chopping around now after hitting 375 and failing. So the way I'm playing this, everybody, is actually I'm positioning myself long for the November-December rally. So I'm giving myself enough time. I'm not going short yet. I'm not seeing the perfect short entry just yet. If we see something like this, a gap fill, one final push to the upside early next week, that might be my perfect entry to go short in the very short term. But so far, everybody, I've been actually building long positions to take advantage of that November-December holiday rally. And by the way, everybody, if you're interested, I do post every single trade and investment in real time in the trading community. It's $20 a month if you go for the annual membership, and it's the best way to track everything that I do and the best way to support me if that's something you want to do. I also posted several charts for very specific stocks that I was looking at where I think will have some really nice edge to the upside versus the rest of the market. Again, all of my trade ideas and investment ideas are in the trading community. Check out the link in the description if you are interested. Now, for the short term, everybody, I still remain cautious. The market is extremely indecisive and the VIX is still high, but we do have a lot of bullish signals. Number one, everybody, the VIX made a double top with a higher high on a closing basis, not on an intraday basis, on a closing basis. This is much more obvious if I change up the look of the chart. Look at this, everybody, a higher high on a closing basis and a lower low on the S&P 500 with a beautiful double bottom formation. This is a typical bottoming formation. We've seen this a lot in the past. Look at this, everybody, the market bottomed. Look at all of these, everybody, the market bottomed, had a small rally to the upside. It continued to form a divergence. It bottomed again, had another rally to the upside. Continued with the divergence, bottomed again, had another rally to the upside, so on and so forth. So the VIX remains bullish, everybody. A high VIX that's declining is a bullish indicator. We also have some other bullish indicators, including weakness in the dollar. Yes, the dollar rallied yesterday to the upside, but it still remains squarely in negative momentum mode. So even this last push to the upside is still in negative momentum. So we have winner faces in terms of the dollar moving to the upside. It is forming lower highs, consecutive lower highs. It is forming somewhat of a pennant. So if we do see a break to the upside, be very careful. We could see a sharp sell-off in the S&P 500. But so far, in the medium term, the dollar is declining. We could see some choppiness, some breakouts in the short term, but in the medium term, still declining. 10-year yield, same story here, everybody. A higher high on the daily chart with a significantly lower high on the PPO. That's a negative divergence. We also have this very, very clear and clean and obvious, to me at least, ascending wedge pattern. This is a bearish pattern, meaning that it will likely break to the downside, allowing the stock market to rally. Because remember, everybody, the stock market hates high yields. I'm seeing the exact same thing on the 2-year yield. It is now taking the stairs up, but it is forming this, again, ascending wedge pattern with a significantly lower high on the PPO, indicating that this is likely a top in yields, at least in the short term. Other interesting developments, the triple Qs actually did fairly well, significantly better than the S&P 500, right? Look at this. It's an indecision candle above an inclining 5-day moving average, above a flattening 9-day moving average, and it's a green candle, not a red candle like the S&P. So this is a risk on signal, but this could easily change tomorrow, especially after that miss from Tesla. Let's take a look at the smart money indicator. Up top is high yield bonds, the HYG. Down below is the S&P 500. This is smart money. This is stupid dumb money. I use this chart, everybody, to track negative and positive divergences. Now, we had two positive / bullish divergences in the last few weeks, and they both resolved to the upside, where the S&P 500 made lower lows while the HYG made higher lows. Now, I'm beginning to see some very, very intricate and small divergence develop. I've been doing this for a long time, and you would need a trained eye to see this divergence, but it is there. Let me show you what I'm talking about. We had this green candle on Monday. We had this red candle Tuesday, and this red candle Wednesday. Now, this is an abandoned baby, right? Where we had a candle, a full body candle above it, and then we opened below it, and we completely abandoned this baby. Now, this is a bearish looking structure, a bearish candlestick structure, but it's not enough on its own. Take a look at this. This is Wednesday's close. It closed below Monday's close, right? So we do have this bearish divergence, while the S&P 500 actually made a higher high on a closing basis. So there is a divergence building. This is the first day of a new divergence, building a negative divergence. These divergences, everybody, take a few days to resolve. And so as this divergence continues to build, we could still see the S&P 500 continue to rally and take out the highs of Monday. While at the same time, the HYG continues to see weakness and making lower highs. Let's take a look at a few ratio charts, everybody. The gold to S&P 500 ratio remains bullish. This buy signal is still active, and every single time it did mark bottoms and reversals to the upside. We could still see some choppy trading over the next few days, but in the medium term, this signal is still bullish. Let's take a look at another signal. This is the XLY divided by XLP. We did see some risk taking yesterday. We got rejected off the 9-day moving average. And I did warn a few days ago that this is very common, where we see this bear flag looking structure. It eventually breaks to the downside. The full measured move will take us to 1.95. This will likely happen over the next, let's say, 5 to 10 trading days, and will very likely mark the bottom for the year, from which we could start to see a nice holiday rally beginning in November. Another signal I'm looking at, everybody, is the CPC buy and sell signal, the put to call ratio buy and sell signal. This sell signal is flirting with a crossover, but we haven't seen that quite yet. So this buy signal still remains active, everybody. And even if we see a crossover above, this would not invalidate the buy signal, because we had a very similar looking structure back here, everybody, in the March low, right? Where we had the low established here on the day of the Ukraine invasion by Russia on February the 24th. Then the market continued to chop around for a couple of weeks before beginning to rally to the upside. And then we did have a couple of crossovers on the PPO, but the market never ended up taking the prior low, and it did end up rallying to the upside. So yes, we could still see some choppy trading going into November, especially everybody, with the VIX still high. Now, the VIX is topping. We do have this double top formation, and then we closed on 2 consecutive days below the 20-day moving average. This hasn't happened in any of these prior pullbacks in this sell-off to the downside that we've seen in the market. So the VIX is still showing signs of a top. The market is still showing signs of a bottom. The stock market continues to be very jumpy, extremely nervous, very jittery in October, which again has historically marked the bottoms in many sell-offs and many bear markets. So again, I continue to be hesitant to place short-term trades. I'm still looking out 2-3 months ahead, because you could easily get chopped up in this choppy trading, which is again very typical of October. Now let's take a look at the economic events that we have coming up. Tomorrow, everybody, will have existing home sales, some initial jobless claims figures, so this could be a market moving event. We also have a lot of Fed speakers, Harker, Cook, and Bowman. And on Friday, we have Fed Williams speaking. In terms of earnings, tomorrow we'll have AT&T, American Airlines, Nucor, and Dow, as well as Snapchat. Friday, we'll have Verizon, American Express, Schlumberger. All of these big companies will help us assess the market reaction. We don't gamble here. We assess risk. We assess the market reaction, and we trade based on our levels. So in summary, everybody, short term, still very choppy, dangerous. We could get chopped to bits here. And that's why I'm focused more on the medium term. Again, the market hasn't given us yet a clean short entry. Just be very careful. Be aware that the market could chop around and really anger both the bears and the bulls. After putting in the June bottom, everybody, we did chop around for over a month before breaking to the upside. And so we're still chopping around here. And this chop will likely continue well into the end of the month. That's all I have for you today, guys. Thank you so much for watching. And I'll catch you in the next one. Bye-bye.
Oh, wow.